This is The Markets. I'm Chris Hussey, and today is Thursday, April 16th. And with me from the London trading floor is Bobby Molavi, who is head of European Execution Services in Global Banking and Markets. Bobby, thanks so much for joining us.
Hey, Chris, thanks for having me.
Bobby, from AI disrupting software to a private credit swoon to now an energy crisis, so many things to worry about, yet the market's at an all-time high. Square the circle for us.
Yeah, it's pretty amazing to think that we've hit a new all-time high in spite of an energy crisis, oil hitting 120 at one point, kind of all the disruptions that have come from what's going on in the Middle East, as well as other kind of idiosyncratic factors like the software concerns from AI disruption, some of the front-end rates moves, the private credit concerns. I think ultimately the equity market is looking through all this noise in the short term, and that's been a winning strategy since 2020, whether it was COVID or tariffs or inflation. The market has paid off in either buying the dip or focusing on the long term, and I think the underlying growth backdrop remains good. Corporate earnings, whilst there may be some disruption because of what's happening in the Middle East, generally have stayed resilient. And I think the equity market has decided to look through this, and some of that is underpinned by the AI kind of tailwind from CapEx, as well as some of the fiscal, monetary, and regulatory tailwinds we thought we would see at the beginning of January.
Good points around the fundamentals. From your vantage point, though, sitting there in Europe and running our execution services, you also get to see a lot of the technical side and positioning. Let's talk a little bit about positioning here, the retail versus the institutional investor, because the retail investor is sort of a new dynamic into these markets nowadays. Do you think any of this resiliency is being exacerbated or, helped by the presence of a retail investor? Or do you think actually that's a worrisome thing because the retail investor can be a little bit more flighty than an institutional investor?
Yeah, it's a great question. I think when you look at the US market, retail participation has grown to around 30% of the daily traded volume. Household ownership is above 50%. And over the last few years, that's been a steady tailwind for the markets, whether it be through the buy the dip kind of mentality I referred to earlier, but also that ownership has been sticky. And we saw that through this recent window. If we look at about the big pools of capital, none of them really faltered. We saw a huge amount of de-netting, and so people taking net exposure or beta exposure down, but we didn't see huge amounts of degrossing. We saw the CTA community sell, and that was on the back of kind of cross-asset volatility and other factors and technical drivers for that selling. But after that passed, we basically saw everyone kind of hold through the noise again, and I think retail has proven to be sticky at every point of stress over the last few years, and this was no different.
Yeah, it's such a great point, is that retail investor is actually a more stickier investor than you would expect. All right, given all that, do you want to chase or fade this rally?
Yeah, it's a great question. I think it's still hard to imagine or believe that the market has been so resilient given the various things we could worry about. Oil's back at $1992, but it's not back to where we were pre-crisis. Obviously, rates now have kind of normalized a little bit, but the hiking versus cutting dynamic still is probably going to result in cuts coming through slower or later than people hoped for. So I think it's delicately poised. I think the market still is pinning itself to the kind of AI CapEx story. Some of those tailwinds I mentioned, particularly fiscal when it comes to Europe, some of those kind of second order themes, for example, AI CapEx and AI disruption, and some of the value propositions and efficiency and productivity from that. But I think we've moved a long way. We are basically pricing in the conflict being resolved. I think there are still some marginal risks of a blip along the way. So fade the rally if I had to choose.
Delicately poised is a terrific term for this market. And, sometimes when it's delicately poised, you don't necessarily see companies come to market, but we are. We're starting to see a little bit of an IPO activity coming back. There's a lot on the calendar. Could the IPO calendar upset this delicate poise here? What are you thinking up there?
Yeah, it's a great question. I think there are a couple of things. When I think about the kind of de-equitization theme of the last few years, retail participation and buying has been one dynamic. That's been steady and consistent. Corporate buybacks, and Q1 was no change there. Authorizations being a record authorization quarter for US corporates in Q1. So that buyback impulse has been steady and de-equitizing. And then M&A in Q1 was actually very solid. And the number of $10 billion plus transactions in Europe or by European companies hit a kind of 5-year high. So we've continued to see equity withdrawal One of the other sides of the coin is equity issuance. And we've begun to see that in kind of secondary sell downs and primary. But we've yet to really see it at scale in IPOs, and it does feel like we're getting closer to some of these extremely large cap tech IPOs coming to the market. And one of the questions is, how will retail respond to that? And also, to what degree will people need to sell to make space for some of these mega cap companies that have grown to huge sizes in the private market when they come to the public markets via IPO? But it does feel like it's getting closer.
Yeah, it's a great point. And usually markets, when they are at an all-time high, you get to start to see a little IPO activity, so you would expect it.
Yep.
All right, Mark Twain once said, the news of my demise is greatly exaggerated. And you could say the same thing about the United States here, right? There's been a lot of talk about fading the U.S., going rest of the world. It is a trade that did work in 2025, though. Where do you stand on that trade? Is everything that's happening making you want to lean more into other parts of the world, or is it actually making you want to lean more into the U.S.?
Yeah, I think it's a bit of both. I think that, kind of one of the stories through 25 was diversification, rest of world, emerging markets, Asia, and the fact that value could be found outside of the US. I think that those people who had diversified exposure benefited from it, but at the same time, capital will flow to where it's most rewarded. And there's no question, and we see that with the Mag 7 over the last decade. We've seen that with some of the AI winners in the public markets. The US has been a good place to store capital. Just looking at NVIDIA, we now look at a company with a $4.8 trillion market cap, and it wasn't long ago we were heralding how amazing it was that it hit 3 and then 4. So I think the US will continue to be the bedrock of where assets and capital flows. They have amazing companies, a diversified kind of pool of kind of banks and tech and innovation, and I think that makes it differentiated. But I do think diversification will continue to be a theme through this year. I'd expect to continue to see money flow into Asia, and we've seen that in regions like Korea, Taiwan, India over the course of the last few years, and obviously Japan most recently. And I think as Europe begins to normalize and concerns around the power and energy crisis begin to be more backward-looking, I'd expect money to flow back into Europe too.
All right, so let's put a bow on all this conversation. What is the trade? What's your favorite?
Look, I think for me right now, the halo theme is one that I'm very focused on. Heavy assets, low obsolescence. I think that in areas where it's impossible to kind of decide or accurately predict terminal value, it's going to be really hard to kind of know where certain stocks should trade at in terms of multiple or trajectory. But I think scarcity is being redefined, and we're realizing there are a bunch of things the world need, all being just one example, hard materials, heavy goods being another, that have been undervalued over the last few years. And the kind of value of those goods in terms of supply chains and companies for key component parts for things like chip manufacturing is being proven out in recent times, and I think that theme is further to run.
Yeah, back to the future, construction, power plants, stuff like that.
The old economy coming back.
As you're looking ahead here into the first quarter earnings season and beyond, what are you watching for most closely?
Yeah, I think it's a great question. I think we move now from macro and geopolitics back towards micro. I think everyone will be looking for kind of a litmus test of what sentiment is like in the C-suite. I think that's been one of the debates around how will the market and corporates react to what they're seeing going on in the Middle East and second order effects from that. I think the second thing obviously is to what degree has the conflict in the Middle East affected either supply chains, input costs, margins, earnings, but also to a lesser extent, their kind of guidance for full year. I think that those things are going to be very, very focused on. We've already seen some signs of immediate impacts in terms of their ability to source parts and goods and maintain the kind of fluid supply chain dynamics that kind of translates into their kind of earnings run rate. So I think that that's going to be one of the things. And then the final thing is consumer sentiment. Obviously, kind of what's gone on and the inflationary impulse does to some degree affect the behavior of the consumer. And I think the market will be very focused on what companies say in terms of leading indicators around shifts in behavior or a certain degree of risk off from a consumer spending dynamic.
So does that mean that these earnings could tell us that the economy is not as strong as we think?
Look, I think the inflationary impulse is a concern. I think the move in the rates market is a concern. I think thus far, most people believe that the consumer and corporates are going to be able to withstand this kind of pressure as they have in previous points. Tariffs being a good example of that. The inflationary impulse post-COVID was another example of that. But I think there is a risk that if this lasted for longer and this kind of oil shock turn from being a supply shock dynamic to a demand shock dynamic, that we'd begin to kind of increase our recession probability. I think the market will watch out for that, but right now it feels like the base case is backward looking, things were fine for Q1, and forward looking, they're pricing more normalization for the curve, continued consumption from the consumer, and kind of steady earnings as was expected when we started the year from corporates.
Lots to watch for. Terrific conversation, Bobby. Thanks so much for taking the time with us.
Thanks a lot for having me.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned as the property of the company to which it relates is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.